Assalamu alaikum. I am Riza Mahmood and I'm along with my two group members Fatma Habib and Fiza Imran. Our presentation topic is Financial Crisis Management and Lessons Learned from Pakistan's Economic History. Introduction. Pakistan economic history is marked by repeated crises including political instability, poor government and economic mismanagement. To avoid future crises, it's essential to learn from Pakistan experiences and implement reforms such as diversifying the economy and exports, investing in human capital and education, practicing fiscal discipline and debt management, promoting political stability and good governance. By learning from past mistakes, Pakistan taking proactive steps, Pakistan can achieve sustainable economic growth and development. Major financial crisis in Pakistan's history 1947 till 1948 post-independence economic crisis due to partition and refugee influx. Pakistan faced significant economic challenges immediately after independence, including a massive influx of refugees and lack of infrastructure. 1958 till 1960 President Ayub Khan's policies lead to economic stagnation and high inflation, which had a negative impact on the economy. 1971 The 1971 war with India and the subsequent separation of East Pakistan lead to a significant economic shock, including a loss of industries and infrastructure. 1980s In 1980s, Pakistan faced a debt crisis and had a sick bailouts from the International Monetary Fund's IMF, which came with conditionalists that impacted the economy. 1990s, Pakistan faced international economic stagnations after conducting nuclear tests in 1998, which had a negative impact on the economy. Then 2008 global financial crisis impact. Pakistan was affected by the global financial crisis, which led to a slowdown in economic growth and an increase in inflation. Then 2013 energy crisis and debt. Pakistan faced a significant energy crisis, including power outages and debt issues in the energy sector. Then 2017 currency devaluation and economic downturn. Pakistan's currency was devaluated in 2017, leading to an economic downturn and increase in inflation. 2022 Political unrest and high inflation and ongoing economic crisis. Political unrest and instability lead to an economic crisis, including high inflation and decline in economic growth. Also in 2022, Pakistan floods causing over $30 billion in economic losses. Floods in 2022 caused significant economic losses, including damage to infrastructures and agriculture. Then 2023, in 2023, highest inflation rate in Asia, 38%. Pakistan's inflation rate reached to a record high of 38% in 2023, making it the highest in Asia.
Pakistan's financial crisis. Pakistan's economic journey has been marked by periods of boom and bust, with several financial crises leaving their scars. Here are some eras in which Pakistan experienced financial crisis and the lessons they learned from it. Era of 1970s. The financial crisis of the 1970s in Pakistan was a complex event with several contributing factors and long-lasting consequences. Here's a deeper dive into this period. The key event is nationalization. Following the 1971 war and the formation of Bangladesh, the new government under Zulfikar Ali Bhutto nationalized major industries and banks. The goal was to achieve justice and reduce income inequality. Consequences of nationalization are many nationalized industries lacked proper management expertise and became dependent on government subsidies, leading to inefficiencies and financial losses. The nationalization drive created uncertainty and discouraged private sector investment, which is crucial for economic growth and job creation. The long term impacts are the economic turmoil of the 1970s hampered growth for several years. Pakistan relied more heavily on foreign aid to finance its budget deficit, making it vulnerable to external pressures. The government's need for financing led to increased borrowing, which became a burden in the following decades. The lessons learned are while social justice is important, government intervention in the economy needs to be carefully considered to avoid hindering efficiency and productivity. A thriving private sector is essential for job creation, innovation, and economic dynamism. The 1970s financial crisis serves as a reminder of the importance of sound economic policies, a stable political environment, and a diversified economy to weather external shocks and achieve sustainable growth. The eras of 1980s. The 1980s financial crisis in Pakistan stands in contrast to the nationalization experiment of the 1970s. Here's a breakdown of the key factors and lessons learned. The key event is oil price roller coaster. High oil prices in the early 1980s initially benefited Pakistan as a major oil exporter. However, the subsequent price crash created a significant revenue shortfall. The debt trap. To finance ambitious development plans and offset the impact of the oil price crash, Pakistan resorted to heavy borrowing, primarily from international lenders. The consequences are as interest rates rose, servicing the growing debt became a major strain on the national budget. Imports continued to outpace exports, leading to a widening current account deficit, further pressuring foreign exchange reserves. The lessons learned are rapid development plans need to be financed sustainably, avoiding excessive reliance on foreign borrowing. Careful debt management strategies are crucial to prevent a debt trap where interest payments consume a significant portion of the budget. A diversified economy, less reliant on volatile commodity prices, is more resilient to external shocks. The 1980s crisis highlighted the importance of responsible borrowing, fiscal discipline, and a focus of long-term economic sustainability. While some argue the liberalization policies helped Pakistan recover in the later part of the decade, the heavy debt burden continued to be a challenge for years to come. The era of 1990s. The 1990s in Pakistan were marked by a complex financial crisis characterized by both initial growth and later instability. Here's a breakdown of the key factors and consequences. The key events are liberalization measures. The government implemented economic liberalization measures including deregulation, privatization, and financial sector reforms. These reforms initially led to a period of economic growth. Stock market bubble. The liberalization of the financial sector combined with loose monetary policy fueled a speculative bubble in the stock market. This bubble eventually burst in the late 1990s, leading to a significant financial losses. The downward spiral is unsustainable government spending and a loose monetary policy contributed to high inflation rates, eroding purchasing power and discouraging investment. External debt continued to accumulate, and with rising interest rates, servicing this debt became a major burden on the national budget. The lasting impacts are the financial crisis of the 1990s significantly hampered Pakistan's economic growth for several years. The economic turmoil resulted in a rise in poverty and unemployment, impacting the most vulnerable segments of society. The high levels of external debt accumulated in the 1990s continue to be a burden on Pakistan's economy. The lessons learned are economic liberalization needs to be accompanied by strong regulatory frameworks to prevent excessive risk taking and financial bubbles. Controlling inflation is crucial for economic stability and investor confidence. Balancing government spending with revenue generation is essential to avoid unsustainable debt levels. A stable political environment fosters investor confidence and facilitates long term economic planning. The 1990s financial crisis in Pakistan highlights the importance of a comprehensive approach to economic development. It underscores the need for responsible fiscal policies, on a focus on exports, and a commitment to long term economic sustainability. The era of 2008. The 2008 financial crisis in Pakistan, while not entirely homegrown, was a significant event with lasting consequences. Here's a closer look at how the global crisis impacted Pakistan. The global trigger is The collapse of housing market in the United States triggered a global financial crisis. The interconnectedness of the financial system meant this crisis had ripple effects across the world. The impact on Pakistan is foreign investors spooked by the global crisis withdrew their investment from Pakistan's stock market. This led to a significant decline in foreign exchange reserves. The economic slowdown in developed countries impacted Pakistani workers abroad. This resulted in a decline in remittances, a crucial resource for foreign currency for Pakistan. Rising global oil and commodity prices increased the cost of imports for Pakistan, further straining the balance of payment. The combined effects of these factors led to a slowdown in economic growth in Pakistan. The longer term effects are the 2008 crisis contributed to a period of slower economic growth in Pakistan. The IMF bailout added to Pakistan's external debt burden. The lessons learned are a diversified economy with a strong export sector is less vulnerable to external shocks like global financial crisis. Maintaining a healthy balance of payment and managing external debt levels are crucial for economic stability. A stable political environment fosters investor confidence and facilitates effective economic policy implementation. The 2008 financial crisis highlighted the interconnectedness of the global economy and the importance of building resilience for developing countries like Pakistan. It serves as a reminder of the need for sound economic policies, a focus on exports, and a commitment to long term economic sustainability. Now, the recent crisis. Pakistan hasn't officially declared a recent full blown financial crisis, but it has been grappling with significant economic challenges since 2022. Here's a breakdown of the key factors contributing to this ongoing situation. Current account deficit. Pakistan's imports continue to outweigh exports, leading to a persistent current account deficit. This puts pressure on the country's foreign exchange reserves. Political instability, frequent changes in government, and political uncertainty make long term economic planning difficult and discourage foreign investors. High external debt burden. Pakistan has a significant amount of external debt, and servicing this debt consumes a large portion of the national budget. Rising global prices. The recent surge in global oil prices has increased Pakistan's import bill, further straining its foreign exchange reserves. The consequences are the these factors have led to high inflation, eroding purchasing power, and reducing people's standards of living. The Pakistani rupee has depreciated significantly against major currencies, making imports more expensive. The economic challenges have hampered economic growth in Pakistan. The government measures are the Pakistani government is currently negotiating a loan program with the IMF to stabilize the economy. The government is attempting to reduce its budget deficit by cutting spending and increasing revenue collection. The central bank has raised interest rates to control inflation, although this can also slow down the economic activity. The situation in Pakistan remains fluid. The success of the government's measures and external factors like global oil prices will significantly impact the country's economic trajectory. Financial crisis management strategies. Now, financial crisis can affect individuals, businesses, and entire economies. It outlines some key strategies to manage them effectively. For individuals, build an emergency fund of 3 to 6 months of living expenses to cover unexpected costs and avoid high interest debt during a crisis. Pay off high interest debt like credit cards to free up cash flow during tough times. Closely monitor income and expenses to identify areas for cost cutting. Prioritize essential needs and temporarily reduce discretionary spending. Explore options to generate additional income like freelancing or a side hustle to mitigate the impact of job loss or income reduction. Don't be afraid to seek financial counseling or government assistance programs available during economic downturns. For businesses, businesses should focus on preserving cash by collecting receivable promptly, delaying unnecessary expenses, and renegotiating payment terms with vendors. Cutting costs without reducing quality is essential. This may involve reducing employee hours, renegotiating contracts with suppliers, or streamlining operations. Analyze debt obligation and explore options to improve the financial situation. This could involve debt consolidation, loan extensions, or negotiations with creditors. Streamline operations and refocus on core competencies. that generate revenue during a crisis. Diversification may be necessary, but prioritize areas with growth potential. Maintain open communication with employees, clients, and investors. Explain the situation, outline the plan, and address concerns proactively. For government, the various tools government can use to stimulate economic activity and restore public trust during a financial crisis. Fiscal stimulus refers to increased spending on social programs and infrastructure projects. This aim to create jobs and boost the economy. Monetary policy involves central banks adjusting interest rates to influence borrowing and investment. Lowering rates can encourage borrowing and spending. Regulatory relief provides temporary relief for businesses from regulations. This can give them some breathing room but should be balanced with maintaining fiscal instability. International cooperation involves collaboration with international organizations like the IMF to access emergency funding and technical assistance. Transparency and public trust emphasizes the importance of clear communication with the public about the crisis, the measures being taken to address it, and the road to recovery.
Case study of successful crisis management in Pakistan. So, number one, which we'll be studying is debt restructuring and IMF programs in Pakistan. So, Pakistan has a very long history of struggling with external debt burdens. This case study explores debt restructuring and IMF programs implemented to manage these challenges, highlighting both success and limitations. So, throughout the 1980s and 1990s, Pakistan accumulated significant external debt, and it was primarily from commercial banks and multilateral institutions like the World Bank and IMF. So, this burden places strain on governments' finances, limiting resources for investment and social spending. So, what we did to fight against this debt was we joined different negotiations, for example, Paris Club negotiations. Pakistan participated in negotiations with the Paris Club, a group of creditor nations, to reschedule debt repayments and reduce interest rates. And second was multilateral debt relief initiatives. Initiatives like the heavily indebted poor countries and multilateral debt relief initiative provided debt forgiveness and restructuring for qualifying countries, for example, like Pakistan. Buybacks and exchanges. In some instances, the government repurchased outstanding debt at a discount or exchanged it for new bonds with lower interest rate. So IMF programs which helped to fight back debt was Pakistan entered into several standby arrangements programs with the IMF. These programs provided financial assistance in exchange for implementing economic reforms aimed at number one, fiscal consolidation. It means that reducing budget deficit by cutting spending or increasing revenue collection. Second was monetary policy, like managing inflation and interest rates to promote economic stability. Third is structural reforms, by liberalizing trade, private state-owned enterprises, and improving governance. So the success of this case study is that debt restructuring helped reduce Pakistan's external debt burden and it helped free up resources for other priorities. IMF programs provide much needed financial assistance during periods of economic instability and our downfall. Economic reforms undertaken alongside with these programs may have contributed to improvement in some areas like macroeconomic stability. So the challenges that we faced is that Pakistan was now highly dependent on external assistance, and it made Pakistan as a weak nation for international institutions. And the strict measures taken by IMF led to unrest and hindered long-term growth perspectives. Debt restructuring did not always address the underlying cause of Pakistan's debt problems, for example, which was weak tax collection and inefficient public spending. The impact of these programs can be difficult to isolate due to the complex interplay of various economic factors. So, the conclusion that we reach about this case study is that debt restructuring and IMF programs have played a significant role in managing Pakistan's external debt challenges. While these measures have achieved some success, the limitations highlight the need for a comprehensive approach to economic development. focusing on domestic resource mobilization, sustainable growth strategies, and social welfare programs. Second case study is privatization and investment initiatives in Pakistan. So this case study explains Pakistan's use of privatization and investment initiatives to stimulate economic growth, focusing on the period during and after the Musharraf regime. So prior to the 1990s, Pakistan economy was dominated by a large public sector with many state-owned enterprises. So these SOEs often suffered from inefficiencies, low productivity, and a huge reliance on government subsidies. So the government aimed to promote economic growth and attract foreign investments. So the initiative was that the government pursued the privatization of various SOEs across sectors, for example, like banking, telecommunications, and energy. So methods included selling shares to private investors, strategic partnerships, and initial public offerings. And investment initiatives were that policies were implemented to improve the business environment and attract foreign direct investments, usually known as FDIs. So these included deregulations, tax breaks, and improved security measures. The government also focused on infrastructure development projects like roads, ports, buildings, power plants. And now, moving on to the success of this initiative, is that privatization in some sectors led to increased investment, improved efficiency, and better services for consumers. Increased FDI boosted foreign exchange reserves and created job opportunities within Pakistan. Infrastructure projects enhanced connectivity and potentially improved long term economic growth perspectives. So, the challenges that we faced with that, concerns were raised about transparency in the privatization process, with accusations of corruption and favoritism in some cases as well. So the benefit of privatization were not evenly distributed across the population. Job losses in some privatized SOEs and rising prices of services after privatization impacted certain segments of society. The long-term sustainability of some infrastructure projects due to high debt burden was a concern. So the limitations of this case study is that the effectiveness of privatization and investment initiatives depends on various factors like sector-specific conditions and implementation strategies. Attributing economic growth solely to these initiatives is difficult due to the complex interplay of economic forces. Now, reaching to the conclusion is that privatization and investment initiatives offered a potential path towards economic growth in Pakistan. However, the challenges associated with transparency, social impact, and debt sustainability highlight the need for careful planning, effective implementation, and robust regulatory frameworks to maximize the benefits and minimize the downsides of these strategies. Now we will go through challenges of financial crisis management. So number one is complexity of crisis. Financial crises are often multifaceted with interwoven causes and far reaching consequences. So, this makes it difficult to develop a one size fits all solution. Speed and decisiveness. Crises often unfold rapidly, requiring prompt action from policymakers. However, gathering information, analyzing the situation, and formulating effective responses can be time consuming. So, number third is moral hazards. Measures taken to rescue financial institutions or individuals during a crisis can create a moral hazard, where excessive risk taking is encouraged by the expectation of bailouts in the future. Balancing act. Policymakers need to strike a balance between providing enough support to stabilize the financial system and preventing excessive government intervention that can distort markets. Long term impacts. While immediate crisis management is crucial, addressing the underlying causes of the crisis and implementing reforms to prevent future occurrences requires a long term perspective. Opportunities of financial crisis management. Systematic reform. A crisis can be a catalyst for much needed reforms in the financial system, addressing regulatory loopholes and promoting greater stability. Strengthening institutions. Crisis can expose weaknesses in financial institutions and regulatory bodies. Crisis management offers an opportunity to strengthen these institutions for further resilience. Building public trust. Effective crisis management can rebuild public trust in financial institutions and the government's ability to safeguard the economy. International cooperation. Crises often have a global impact. Collaborative efforts among countries to manage financial crises can lead to more effective solutions. So the last is promoting innovation. Economic downturns can incentivize innovation and the search for new financial products and services that cater to a changed economic landscape. Overall, financial crisis management is a complex undertaking with both challenges and opportunities. By acknowledging the difficulties involved and capitalizing on the potential for positive change, policymakers can strive to navigate crisis and build a more resilient financial system for the future.
Conclusion. Pakistan's economic history has been marked by crises including fiscal deficit, inflation, and balance of payment problems. However, these challenges offer important insights for future management, like diversification of the economic is critical. Moving beyond a few sectors like agriculture and textiles to create a more robust and resilient economic base. Fiscal discipline involves management of government financing, avoiding borrowing and spending, and ensuring revenue generation meets expenditure without resorting to unsustainable debt accumulation. Investing in human development and infrastructure enhance productivity and laying the foundation for sustainable economic growth. Political stability. Political stability is essential for creating an environment to invest the economic development. Effective management of external shock involves policies mitigate impact of global economic fluctuations such as trade or challenges in commodity prices. By incorporating these strategies, Pakistan can reduce the likelihood and severity of future crises, promoting long-term economic stability and prosperity. Thank you.